You weren't supposed to hear this. Not like this. Not framed this way. Because once you understand what's really happening between Bitcoin and gold, you can't unsee it. What looks like a simple debate about assets is actually a quiet war over control, trust, and the future of money itself. And right now, while most people are distracted by prices, headlines, and noise, the real moves are happening in the shadows, where institutions don't speak, they position. If you want real financial truths, they don't teach. Hit subscribe and turn on notifications. You don't want to miss what's coming. Because what I'm about to explain isn't investment advice. It's a psychological autopsy of the global money system. And once you hear it, the market will never look the same again. For months, maybe even years, people have been arguing about whether Bitcoin or gold is the better store of value, as if that question itself isn't already a trap. Gold bugs scream that Bitcoin is fake. Crypto maximalists laugh at gold as a relic. Retail investors pick sides like it's a sports team. And while everyone argues, institutions are quietly buying both. That alone should bother you. Because when the smartest money refuses to choose sides, it usually means the public narrative is wrong. At the surface level, the story looks simple. Bitcoin dipped, then bounced. Gold climbed, pushing toward historic highs. Bitcoin trading around 70,000. Gold approaching 5,000 an ounce. Analysts say it's about inflation. Commentators say it's about interest rates. Influencers say it's about the next bull run. But none of that explains why the biggest players on Earth are accumulating these assets at the same time, during maximum confusion, while telling the public completely different stories. Here's the part most people miss. Markets don't move based on truth. They move based on perception, liquidity, and human behavior. And the human mind is the real battlefield. Fear forces people to sell the bottom. Greed convinces them to buy the top. Media doesn't inform, it conditions. And retail investors, without realizing it, are herded into predictable emotional patterns that can be exploited again and again. Bitcoin's recent volatility didn't scare institutions. It attracted them. Because volatility is where transfers of wealth happen. When prices swing violently, weak hands exit and strong hands absorb. And right now, despite the noise, Bitcoin dominance is rising. That's not an accident. That's capital rotating out of speculative chaos and into what institutions now see as the core of the digital monetary system. This is where Cathie Wood enters the picture, and whether you agree with her or not, you should listen closely to what she's actually saying, not how it's being summarized. When she talks about AI, agentic commerce, and blockchains becoming financial infrastructure, she's not pitching a trend. She's describing a shift in how value moves through the world, a world where machines transact with machines, instantly, globally, without permission. In that world, programmable, secure, censorship-resistant money isn't optional. It's required. Bitcoin, in that framework, stops being a speculative asset and starts becoming a base layer, a settlement rail, a digital reserve. And that's why institutions don't panic when retail users disappear temporarily. On-chain data showing fewer active users doesn't mean Bitcoin is dying. It means the crowd has stepped back, while the long-term players quietly step forward. At the same time, gold is doing what gold has always done. It's absorbing fear, it's responding to uncertainty, geopolitical tension, and the slow realization that fiat currencies are being diluted beyond repair. Gold doesn't promise growth, it promises survival. And in times like these, survival becomes valuable again. But here's the twist. Gold and Bitcoin aren't enemies. They're signals. Gold often moves first, absorbing stress in the system. Bitcoin follows, amplifying that signal with speed and magnitude. When Cathie Wood says gold precedes a big move in Bitcoin, she's pointing to a pattern institutions have studied for years. Gold sniffs out monetary stress early. Bitcoin reacts later, but more violently. This is why institutions aren't asking gold or Bitcoin anymore. They're asking how much exposure to each gives them maximum protection and maximum upside during a monetary transition. Gold anchors, Bitcoin accelerates. Together, they hedge against debasement, policy mistakes, and systemic resets. And make no mistake, currency debasement isn't a theory, it's a policy. Inflation isn't a bug, it's a feature. It quietly transfers wealth from savers to debtors, from the public to the state, from labor to assets. Cash loses value while real assets reprice higher. And every cycle, the same story plays out. Those closest to the system protect themselves early. Everyone else reacts late. Rising Japanese interest rates, tighter US liquidity, slowing growth in China. These aren't random headlines, they're pressure points. And when pressure builds in one part of the system, capital looks for escape routes. Sometimes that escape is gold, sometimes it's Bitcoin, sometimes it's both. What's different now is that Bitcoin is no longer isolated. It's entangled with global finance. When liquidity tightens, Bitcoin feels it. When liquidity loosens, Bitcoin explodes. That sensitivity doesn't make it weak, it makes it honest. It reflects stress in real time, without filters. This is also why the old 4-year Bitcoin cycle is breaking. Not because Bitcoin changed, but because who owns it changed. Early cycles were dominated by retail speculation. This cycle is being shaped by institutions with longer time horizons, deeper pockets, and different objectives. They don't chase candles, they accumulate quietly, they distribute slowly, and they use volatility as a tool, not a threat. Meanwhile, media narratives lag behind reality. When Bitcoin drops, headlines scream collapse. When it rises, they say it's too late. The goal isn't accuracy, it's emotional manipulation. Fear generates clicks, hope generates exits, and most people don't realize they're being emotionally steered until their capital is gone. Here's the uncomfortable truth. Most retail investors aren't losing because they're stupid. They're losing because they're human, and the market is designed to exploit that. Whales understand this. Institutions understand this. They know exactly when panic peaks, when boredom sets in, when hope returns, and they position accordingly. Right now, we're in a phase where confusion dominates. Bitcoin isn't crashing hard enough to create capitulation. It's not pumping hard enough to trigger mania. Gold is strong, but not euphoric. This is the zone where accumulation thrives. Silent, boring, invisible. And while retail waits for certainty, certainty never comes. By the time it feels safe, the move is already underway. That's how it always works. That's how it's designed. So ask yourself this. Why would institutions publicly debate Bitcoin versus gold while privately buying both? Why would they downplay Bitcoin's role while integrating it into portfolios? Why would they allow narratives of fear and doubt to dominate, while their balance sheets quietly adjust? Because the real game isn't about price. It's about positioning before repricing. And repricing always happens quietly at first, then suddenly. The warning is simple but uncomfortable. If you wait for clarity, you'll pay a premium. If you wait for consensus, you'll be late. And if you let fear or greed dictate your decisions, you'll be liquidity for someone smarter. This isn't about predicting the next candle. It's about understanding the direction of power. Money is changing. Value is migrating. And the people who see it early don't announce it. They act. So here's the final question I want you to sit with. If the smartest money in the world is preparing for a future where gold and Bitcoin both matter, what does that say about the future of the currency you're saving in right now? Because once you understand that, the debate ends, and the real thinking begins. This is bigger than Bitcoin, bigger than gold. It's about control, trust, and who adapts before the system forces them to. That's the secret most people will never understand. If this changed the way you see money, comment below and tell me which asset you think institutions are really afraid of retail owning early. Send this to someone who needs to hear it. And if you want to stay ahead of the narratives, subscribe now, because the next move won't be announced.